Roses are red, violets are blue. Here are 4 stocks that could interest you. I bet you $20 that you did not expect this video to start with those words, right? If I'm correct, just hit all the buttons. That's all I'm asking. You might even be the 60,000 subscriber of this challenge. I think I earned a little bit of your attention. Now, if you don't want to stick around for the whole video, I'll just show you the 4 stocks right now. So we're going to talk about ASML, ENPH, Celsius, and Lam Research, and I'm going to show you a little bit of Pepsi as well as a little bonus. And I truly hope you keep watching. And so let's start off with number 1 here, ASML. You can buy it on the Amsterdam Exchange or in the United States. Now, this is a giant in the semiconductor space. It has a market cap of $262.8 billion, operating in a monopoly, some might even say. But if you look at the stock right now, year over year, the stock is down actually 1% or so, depending on when you're watching this video. Year to date, the stock is going to be down close to 11%. And actually in the last 3 months, the stock is down closer to 30%. Now looking at some forward-looking metrics here, forward PE, EV to sales, EV to EBITDA, forward PE 27.5 times, EV to sales 7.8 times, EV to EBITDA 22 times. Now, that doesn't tell you much, right? Okay, I admit, so I'll show you something else in just a second. Let's first look at what the analysts are expecting for fiscal 2024, basically a decline in sales and EPS. Fiscal 2025 and fiscal 2026 should see the company grow top and bottom lines. If we currently look at the average analyst price target, that sits close to 33% higher than the price we're at right now. We've got 39 analysts covering this company, 10 with a hold rating, 21 with a buy, and 8 with a strong buy. Now, I've shown you the forward PE, EV to EBITDA, price to sales, and all of that before, but that didn't really give you much information. Now I can show you the forward PE and all of that compared to the 5-year mean. And what do we see right now? Well, we see that compared to the 5-year mean, for forward PE, EV to EBITDA, and price to sales, we are currently lower than before. Where are we higher? And that's price to free cash flow, because that's, first of all, in the last 12 months, and you will see in just a second that free cash flow has been decreasing. Now, what has also happened throughout this period is, of course, the pandemic, huge backlog, supply chain issues, stuff like that, and of course, well, 2021, where every stock was extremely overvalued, so you have to take all of that into consideration. Now, looking forward, looking at price earnings to growth, 1.53, not undervalued, not the cheapest one that we've seen, but definitely not the most expensive one. Now, before continuing, if you enjoy this type of videos so far, if you want to support me even further, do check out the link down in the description and in the pinned comment with the top 10 best stocks to buy now, or go to foo.com/couchinvestor. Thank you very much. Now, if we zoom out a little bit for ASML, we look at revenue and free cash flow and the free cash flow growth that's expected. I mean, you can see that free cash flow growth has come down. Free cash flow has basically decreased in the last year and a half too, but it's expected to grow back. It's expected to grow quite quickly in 2025 and in fiscal 2026. Now, we also know from management that, well, the expected rebound in 2025 will not be as big as previously expected. Now, what we've also seen is that net bookings have come down. They've come in quite low as well. There are a lot of big players in the semiconductor industry that, well, are cutting back on their plans to increase build out, to build new factories around the world, to acquire such machinery, right? These things cost hundreds of millions of dollars. And by the way, by 2030, ASML is going to sell a machine that is going to cost double the one it's selling right now. And yes, there is of course the China risk, right? If we look at the net system sales breakdown, we can see that the Chinese region here is 47% of net system sales. Okay, it was 49% previously, but they think this will decrease yet again. They also told us that the reason why it is so high, and that's because of, well, the pandemic, the huge backlog that they had. So a lot of the focus did go to China because there was a backlog, but it should go back to normal in the 30%. Now, of course, with tariffs, restrictions, Donald Trump, let's see what happens with China. Now, if we do here a quick reverse DCF, we plug in the free cash flow trailing 12 months. Of course, we know that free cash flow is expected to rebound, but then again, it would be cheating if we start switching those numbers here. So we get an implied growth rate of 23% to justify today's price. Now, we have seen that in the next 2 years, it's going to grow faster than that. So, okay, maybe right now you think, yeah, maybe I'm paying a premium, but then again, the stock is down quite a lot. It's still a very, very strong company. I mean, operating in a monopoly, and I don't see it going anywhere anytime soon. Yes, maybe the rebound will take longer than expected, but when do you think you're going to make money, right? You're making money essentially when a company's financials, margins, whatnot, are near the bottom or at the bottom. You usually don't want to buy stocks where margins have peaked. You want to buy when they are quite low, when they have been hit, and the stock has reflected that as well. I don't know if today is the bottom or tomorrow, but today's price is already better than a couple of weeks and a couple of months ago. Plus, this company is still going to be in a super advantageous position for years to come. Moving on to company number 2, and that's a company we've actually covered not so long ago. I covered ENPH and First Solar, I believe, a week or so ago. So if you want to watch a fuller video about these types of companies, I will put it in the top right corner. Now, ENPH is a stock that is down 32.5%. Yes, it has rebounded a tiny bit in the last couple of days. We've seen an 11% rebound, but I mean, year to date, the stock is down close to 50%. It has a market cap back under $10 billion. I mean, still under $9 billion, a forward P of 19.1 times, but I'm going to show you the forward Ps and all of that compared to the 5-year mean. Looking at what the analysts are expecting, well, no surprise, fiscal 2024, a horrible year, sales down 41.8%, EPS down 50%, but what do we see in the next 2 fiscal years? Well, we see again huge growth, top and bottom lines. And so here as well, this is basically me saying you should buy a stock when things are near the bottom instead of near the top. And with ENPH, you can always play the options game as well. Leaps 2026, 2027 look quite attractive. Now, currently, if we look at the average analyst price target, that sits 48.2% higher than the price we're at today. And here it should come at no surprise that the forward PE, EV to EBITDA, price to sales, price to free cash flow are all well under the 5-year mean. And if we look at price earnings to growth, this signals this stock being undervalued. It's under 1, it's at 0.78. Now, of course, with ENPH, I mean, a high interest rates environment is hurting these types of businesses. And with Donald Trump coming in and people saying, oh, he's going to remove the IRA tax credit, it's going to hurt companies like ENPH, like First Solar, like Tesla, etc., etc. Me personally, I don't think so. I think companies that create US jobs, that manufacture also in the US, will still benefit from a tax credit one way or another. You want to be the country that is leading in renewable energy. You don't want to be the one that is hurting these types of companies. So I don't know, maybe the tax credit will be tweaked. I just don't think it will be removed, especially not for these types of companies. For EVs, maybe, but for companies like First Solar, like ENPH, those types of companies, I don't think so. I can be wrong, and I think the market has signaled that there are some doubts. That's why the stock is down quite so much. But yeah, if you're willing to take the risk and bet at these prices, I think you could be more comfortable. With ENPH, it's quite clear what has happened. Huge growth in the last couple of years and then a huge decrease in growth. And the same is happening with free cash flow, though here free cash flow is expected to grow by 25.4% in fiscal 2025 after being down 28.8% in fiscal 2024 and then growing another 22% in fiscal 2026. Now, remember that number because we're going to use it in the reverse DCF. Zooming out even more, the picture is quite clear. Huge growth, revenue, free cash flow, and then, well, huge deceleration in growth and decrease in growth, shall I say, although margins have held up quite nicely, and that shows the strength of ENPH. In my opinion, when interest rates come down even more, this company should see a reacceleration in growth. Last quarter, we've also seen finally that revenue quarter over quarter has gone up. For Q4, it's expected to be flat-ish. Hopefully, it's not flat-ish, meaning on the downside, but back up over $380.8 million. Doing a quick reverse DCF here with the $336 million in free cash flow for the trailing 12 months, we can see that the implied growth rate to justify today's price sits at 7.2%. And as we've seen before, it's expected to grow above 20% for the next 2 fiscal years. So yeah, in my opinion, this could be a buying opportunity. Again, you can play the options game. You can also sell puts, which I'm starting to learn more and more about because I'm usually far away from the options game. But now with the market being up so much, there are some companies where I would love to add more shares, but not at those prices. And so selling puts is a great strategy. Of course, it's a bit more risky, but it's a great strategy to have the option to buy shares at a lower price if that happens. And if not, you collect a premium along the way. Moving on to company number 3, and that's Celsius Holding. Now, Celsius, we've talked about that company quite a lot. Celsius is down 44% in the last year. It's down year to date 46%, and in the last 3 months down 29%. Now, in the last couple of days, this stock has seen a small rebound, up 14.22%, closing in on that $30 mark. Here we have a market cap of $6.89 billion and a forward PE of 34 times. So definitely not on the cheap side. But why is that? Why is that? Well, first of all, again, if you look at the analyst estimate for fiscal 2024, sales growth of just 3.6%, that's not much, but EPS decreasing 10.7%. If we then look at the coming fiscal years, the 2 coming fiscal years, we can see again the same story. Growth should reaccelerate for sales and for EPS. Looking at the average analyst price target, that sits 42.6% higher than the price we're at today. We've got 18 analysts here covering this company, 1 with a strong sell, 4 with a hold, 8 with a buy, and 5 with a strong buy. Looking at forward PE, EV to EBITDA, price to sales, price to free cash flow, same story here. Stock currently is trading at a multiple that is much lower than its 5-year mean. And so zooming out a little bit here, what can we see? Well, we can see a company where revenue has grown a lot and super fast in the last couple of years. Now it's expected to be flat-ish, but we should expect a reacceleration. And when you see this reacceleration of revenue, if margins stay about the same, then we should see free cash flow grow 7.3% in fiscal 2025. And then in fiscal 2026, it should reaccelerate by 35.9%. Zooming out even more here, as revenue has gone up, well, the company has become free cash flow positive. We've seen gross profit margin go up and up and up again. Now the question is what happens next, right? International expansion. Is Pepsi going to place big orders again in 2025? Because currently the big hit is basically because of Pepsi, right? Pepsi a year ago made a huge order and that definitely helped the company, right? That definitely helped the company, but now it's a huge headwind. So remains to be seen what happens with that. They are the 3rd largest player in the energy category behind Monster and Red Bull. The reason why the energy category has basically moved a little bit this year or has not actually imploded this year is thanks to Celsius. So they are gaining market share. They are a big player. They are getting their name out there, the brand out there. In the United States, it's already pretty popular. Internationally, they are starting to grow more and more. Again, just because you are growing internationally or expanding internationally, shall I say, does not mean that you're going to be successful. But so far, I mean, it's a small base, but so far internationally keeps growing quite nicely. It's up 37% year over year. North America, of course, is taking a hit. Gross margin has also taken a small hit. They've also acquired a company last quarter, but all in all, this company is doing what it should be doing. It's just a shame that they're taking a big hit because of that previous big Pepsi order. Now I already know what people will say, oh, but with RFK coming in, isn't that going to hurt energy beverages? Well, that's just my opinion here. To be honest, I think there are way more important things to focus on than energy drinks, right? I mean, you still have alcohol, you still have tobacco, you have plenty of other stuff flowing around there, some drugs here and there, medical stuff that are probably higher on the list of priority, right, than a energy drink that tastes okay, mango passion, watermelon. Yes, it's true that maybe it's high in caffeine, but then again, Nobody told you to drink 10 of those a day, right? It's up to you. You still have the freedom of choice whether you want to consume these types of products or not. Maybe they'll have to put a label on that, high in caffeine and something like that. Okay. But to say, oh, RFK is going to destroy these types of businesses, to be honest, to me, the fear here is a bit overblown. That's just my opinion. Now, reverse DCF here, 170 million in free cash flow trailing 12 months, closer to 169.7, but okay. Then we can see that the implied growth rate here is 12.3% to justify today's price. We've seen that in fiscal 2025, it's lower than that, but then in fiscal 2026, it's basically double that number. So is it the cheapest one out there? No, but I think we're going to see growth reaccelerating faster than expected. So the implied growth rate here, to me, puts it at a moderate buy. Moving on to company number 4, and that's Lam Research. Now, Lam Research also has a couple of headwinds, of course. China, major companies may be not inclined to order more equipment as of yet, so growth might be slowing down. But all in all, right now, even with the current expectations and all of that, this is a tremendous company. Stock is up 3.7% year over year. Year to date, stock is down 6.6%. And in the last 3 months, this stock is down 16.57%. Has a market cap of $93.4 billion and a forward PE of 19.9 times. Also pays a small dividend, same with ASML. Analyst expectations here. You can see even for fiscal 25, fiscal 26, fiscal 27, top and bottom line growth. In fiscal 2027, sales growth, single digits here, high single digits, 9.23%. But all the rest, I mean, isn't this a lovely business to see, to hold? I mean, I think so. Looking at the average analyst price target, that sits 29.2% higher than the price we're at today. 32 analysts covering this company, 12 with a hold rating, 16 with a buy, and 4 with a strong buy. Looking at some pricing metrics here and here compared to the other, the picture is a bit different because we are sitting bang on the 5-year mean for most of these pricing metrics. Price to free cash flow is a bit lower than if you look at price earnings to growth, 1.26, definitely not expensive. Zooming out a little bit here, what we get is a company that is growing and has grown quite nicely in the last couple of years. Now it's in a moment where growth has decelerated a little bit, but should reaccelerate in the next coming years. And free cash flow is basically reflecting that a little bit. For fiscal 2025, free cash flow should be up 16.2% and then basically be flat year on year for fiscal 2026 and then reaccelerate to 14.7% year over year growth in fiscal 2027. Overall, what we're seeing here is that, well, previously, first of all, you've got two business segments. You've got the systems revenue and the customer support and other revenue. What we've seen is that systems in the last couple of years has grown quite quickly with the same story as ASML. And then more recently, that has decelerated a little bit, although in the last couple of quarters, we've seen a small reacceleration. Gross profit margin did go up quite a lot since Q1 2023. Now with Lam Research, the same story as ASML, China is a big chunk of their revenue. So yeah, that's basically also the risk here. Quickly looking at the reverse DCF, what we see is that the implied growth rate to justify today's price, the implied growth rate for free cash flow is at 3.2%. In my opinion, very, very cheap. So this would be considered as an easy buy if you want to get exposure to that side of the semiconductor ecosystem. And then the last one, basically a bonus here, is PepsiCo. So PepsiCo is basically flat year on year. Year to date, the stock is down 2.3%, and in the last 3 months, the stock is down 6.8%. Here we've got a company with a market cap of $222.2 billion, a forward PE of 19 times. You already know probably why Pepsi and Coca-Cola have such a high multiple for a company that is not really expected to grow that fast, right? It's because, well, the cash flows are so-called secured. So you get a premium. This company also pays a nice dividend with a dividend yield of 3.35%. Looking at the average analyst price target, that sits 12.31% higher than the price we're at today. And then if we look at the pricing metrics, forward PE, V to EBITDA, price to sales, price to free cash flow, most of them are below the 5-year mean. Price to free cash flow is basically the same, but price earnings to growth is, well, quite expensive here, 3.21. Now with Pepsi, what you can see here is solid, steady growth in revenue, and the same for free cash flow. I mean, if you zoom out, this is basically what you get. And plus, more recently, gross profit margin has seen a rebound. But all in all, I mean, the last 10 years or so, yeah, this is slow but steady growth, and free cash flow basically remains approximately the same. And here, if we do a quick reverse DCF, we can see that the implied growth rate to justify today's price sits at 11%. Now, of course, you might think, oh, this is a boring business, 11% here, maybe not. But remember, you're also getting a dividend and they're buying back quite a lot of shares. So yes, for these types of businesses, Pepsi and Coca-Cola, you're always going to pay a small premium, because currently the mindset here is that, well, these companies will be here for years and years to come and their cash flows are basically secured. So yeah, it deserves a premium. So voila. Anyways, that's all I've got for you right now. If you enjoy this type of videos, leave it a thumbs up, subscribe if you have not, and I'll see you all in the next one. Bye bye.